This is our basic dynamics in S&P 500 because we are focusing on general the United States financial market because they are the heart of the financial sector all around the world. By the way, before starting the presentation, I should emphasize a point. After the COVID-19 crisis, we started a quantitative easing period, but as the inflation tries started going down, the Federal Reserve, ECB, and other developed market central banks are started the quantitative tapering process. And the last stone for the paving way of the quantitative tapering is the reduction in the interest rate cut. So the first central banks, the biggest central banks, the ECB, in the June monetary policy meeting, the European central bank started to cut the interest rate 25 basis points. But now the Federal Reserve yet not started it, but it is pricing. It started its reduction in interest rate cut process in September 2024, approximately after 2 months. So you should also keep in mind that how the interest rate cycle and the valuation in stock markets and stock exchange will affect each other and how they have correlation between each other. Now, as I say, the S&P 500 is the heart of the financial sector all around the world. And this is, as you see, the S&P 500 approximately 30 years. In the x-axis, you will see the time period and the years. And in the y-axis, you will see how its valuation moving throughout the lifetime and cycle. These are multiples, and this title, as you see, the forward PE ratio, meaning price earning ratio. And this green dashed line showing the one standard deviation plus one standard deviation from the average and minus one standard deviation from the average. And this middle dashed line showing the 30 years average in the price earning ratio. And now, as you see, the valuation metrics summary as reflected here. What is this table trying to tell us about the price earning ratio and the valuation, or how it is cheap or expensive in the financial market? Let's try to understand what is it meaning. The price earning ratio is showing generally if you don't have, or let's say you have lots of metrics, valuation metrics like the EBITDA margin, like profit margin, like earning per share, EPS growth, or price earning ratio. But from all those above, if you want to choose the basic and standard fundamental one, it will be the price earning ratio. Price earning ratio is the standard core and central valuation metrics and showing how much the index, equity, or the financial market is expensive or cheap. Okay, by just looking at the price earning ratio, you will just get a message. This does not mean that by only looking price earning ratio, I can buy or sell. No, it is not that. It is just giving a direct signal to you about how much cheap and expensive those indexes or valuation. So as you see here, you will see the 30 years average for all these indicators. By the way, here, this is price earning ratio, capital expenditure, dividend yield, price to book ratio, price to cash value ratio, and earning and yield spread. Okay, what does this mean? For instance, let's say price to book ratio. What does this price to book ratio? Because you should understand the notation behind and story and philosophy behind those, just the name. Price book ratio is this. Let's say you are the Microsoft, the company, and you have lots of factories all around the world, lots of employees, lots of machines, lots of equipment. And those have some prices and value in the book, right? In your balance sheet, in your income, you have, let's say, today you buy lots of monitors. And let's say each monitor have $200. Let's say you bought approximately 200 million monitors. So if each has approximately $200, you approximately have just monitor valuation in your book, in your balance sheet, approximately 400 million. But now, if I calculate all those valuations, factory, employees, cars, machine, in my company, this is my book value. Okay, this is the real price of my book value. But according to those book values, my stocks, Microsoft stocks, have a price in the stock exchange, Nasdaq, right? And if I divide this price, the Nasdaq price, to my book value, I will have a ratio. And if this ratio is greater than 1, what does this mean? My real book value, if I sell all my factories, all my machine, all my equipment, all my investment, I will have a money, and this will be my book value. But if the price is higher than 1, this ratio is higher than 1, this meaning that market, the investor, giving a notation that the price of the Microsoft is higher than its book value. So it's expensive. Okay, you can understand directly from there that it is expensive. Because if I sell all my equipment, all my investment, all my machine, factory, cars, everything, I will have a money, but this money is less than the money in the stock exchange. This means that investors have a miscalculation about my company. They expect and forecast that this company have a higher price than their book value. So, as the core central issue today, the price earning ratio, let's look at what is the 30 years average of the price earning ratio. By the way, what we mean by price earning? Price, again, the price in Nasdaq, and the earning is the earning of the Microsoft at the end of the year, net income. Okay, this is my profit. If I divide my price to profit, what does this mean? If my price to profit ratio is decreasing, what does this mean? Either my price is decreasing or my profit increasing, if this ratio is decreasing, right? If the price earning ratio is decreasing, I have two possibilities. Either my price decreasing in the stock exchange or my real earning is increasing. So I'm a good company if the price earning ratio is decreasing, right? So look at this. 30 years average in the price earning ratio is around 16, 17. But today, the price earning ratio is 21. What does this mean? Look at the table here. What is the 30 years average? It is around here, 17. But today, the price earning ratio is approximately 21. What does this mean? My company is expensive. So if you buy and invest to my Microsoft company, let's say, it is more possible that you will lose money than you earn higher money in the investment of the Microsoft exchange. So the basic decision-making process will be like this. Please look at this 30 years average dash line. If, let's say, Dr. Lambert have $1 million, he wants to invest his money in the stock exchange, and he wants to decide a company. He opened the price earning ratio graphic chart, and he see the screen, and he see that the 30 years average is around 17, and today the price earning ratio is 20. So Dr. Lambert can directly say that this price earning ratio today is higher than the 30 years average, and this company is expensive. It's better for me.
Abdulkadir, your audio is breaking up. I'm going to turn off your video so that your audio is good.
That's right.
Okay, now let's let your bandwidth kind of catch up here for a second. But you'll have to go back about 10 seconds and repeat what you said. still breaking up a little bit. Sounds like it's getting better.
I don't know the reason, but could you hear me right now?
Okay, it's getting better.
Right. Can you put something from the analysis? If they can also put the camera, we can increase the efficiency in our session as well, if possible. Okay. Now the sound is better, Dr. Lambert?
Yes, we can understand what you're saying now. It's a little broken up, but we can still understand.
Okay. Actually, I'm checking my screens. Hang on a sec. I'm closing the other background.
Do you want to reload? Do you want to reload your page? Just leave and come back in. I think it'll reset better.
I have a request from the analysis. If you can also close your camera, analysis, if you can close the camera, we can speed our efficiency. Not just my camera, but your camera is also closed. It will be better for production.
Yeah, I suggest that you leave and then come back into the meeting, and I think your audio will be better. Yeah, I think you need to reset your connection. So I'll wait for you, and when you come back in, I'll let you in. Okay. So yeah, I think you all understand. Hold on. I think you all understand price to earnings ratio. You know, it's just a simple division. So if that number goes up, that means the price is getting greater relative to the earnings, which means the earnings is getting less and less in comparison to the price. So the price to earnings ratio is actually a very important measure of profit. And that will affect the ultimate price, because it should probably bring the price down. If the price is too expensive, people will probably think in the long run, the price has to come down or the earnings have to go way up. So Abdulkadir, are you still here? No, I don't. I see you here, but I don't hear you at all.
No.
No, I can't hear you. So I suggest that you leave the meeting and come back in. It'll just take 10 seconds, but you'll be able to reset your connection. And so when it comes to investing, I suggest that you get out some graphs and some papers and take notes and watch how prices change, and then look at the news and see how the news is affecting the prices. And do this over time to see how the price earnings ratio changes, the stock prices. Just look to see how that changes over time. So it's the way you want to educate yourself about these investments, you know, what you're going to invest in. Track it over time before you jump into the market. Study it. That's what I did. I was studying future markets. I was studying soybeans. And this was back in the early 1980s. And I was studying the future markets for soybeans. And every day I would cut out the price of soybeans and then write a paragraph in the news of what was important in the news about soybeans. And I did that for 3 years. studying all the little changes. Soybeans was being grown in various parts of the world. And so how the weather would affect different parts of the world, the economics in different parts of the world, and many factors, trade agreements, all that stuff was affecting the price of soybeans. So I began to really understand what affected the price of soybeans. And so then one day I was looking at the price of soybeans and I just knew. I just knew the price was going to go up. So I went ahead and bought some soybean futures, which is very risky for people who apparently don't understand the market. But I felt at that point in time, I understood the market of soybeans. So I put some money into it and tripled my money. And so that those 3 years of studying the soybean market paid off. And that in a moment, I just knew that the price had to go up. And to me, that was my success story with investing. And I suggest that you do the same. Find something that you want to really understand and something you feel like you could make money in, and then just study it. If you find all of your information online, copy and paste it into a little notebook in your computer, and then just read over that and be aware. And through time, you're going to see trends in the news. You're going to see trends in prices. You're going to come to understand what a normal price is for that particular stock or commodity or area of the market, like industrials or um, bonds, whatever it is. You begin to understand what a normal price is. Abdul Kadir, are you back?
When you said me last time, because you are here, it was frozen, and I'm trying to answer you, but it's frozen. But now I think it's perfect.
Okay, I can hear you much better now.
Yeah,
Okay, go ahead.
yeah, everybody can see my screen again.
Yes, and we can hear you much better.
Yeah, last time I said Dr. Lambert had $1 million. He want to invest his money, and he decided to go into Nasdaq Stock Exchange. And he see the screen. This is the chart, and he wants to put his $1 million in Microsoft Stock Exchange, or let's say directly in the S&P 500 index. And today the price earning ratio here 21, but the 30 years average for the price earning ratio in the Nasdaq Stock Exchange S&P 500 is around just 17. What does this mean? Today price earning ratio is higher than the 30 years average. So if it is higher than the average, what does this mean? It is expensive. Today, the United States Stock Exchange is expensive. You can understand everything from here as well, not just the price earning ratio. Please look at this. Price to cash flow ratio is just 11 for the 30 years average, but now it is 16, again higher. Or let's say price to book ratio. Even it is higher than for one, it is expensive, but 30 years average is 3, but the today ratio is even higher than the 3, and it is 4.3. So again, so by the way, you should also keep in mind that if the price earnings ratio showing that this stock exchange is expensive, other indicators will not signal to you that it is cheap. They will also show that it is expensive. But how much it is expensive, you can differentiate, and you can make a decision-making process by looking other indicators as well. But according to price earning ratio, today the S&P 500 approximately 4 times higher, 4 multiples higher, the 30 years average. So it is not a good decision to put your money in the United States Stock Exchange on these days. Now, let's look at the price earning ratio and 1 year's return relationship. And this is showing the R curve, R square, meaning how much they can explain each other, how they are correlated. So as you see from the table and line, this orange line showing that they have a negative correlation, negative relationship. The price earning ratio has a negative relationship with 1 year return. Why? It is basic. If the earning is increasing, price earning ratio will be decreased. So they have a negative correlation. As the return in the stock exchange will rise, the price earning ratio will decrease. And if I can take a look at about the 5-year annualized return in the subsequent period and forward price earning ratio, it will also have a negative correlation. And it is good news fit is better. Here just 7% correlation, but here 27% correlation between 5-year annualized return and the forward price earning ratio. And today we are here, and again they have a negative correlation. So if my price earning ratio increasing, my 1 year or 5-year return will decrease. So if my return is decreasing, my profit decreasing, no need to invest this type of stocks. And if I look at what are the sources of earning in this type of sectors and the subsequent investment decision-making process, this left-hand side chart showing approximately 24 years S&P 500 year-over-year pro forma EPS growth. What does this mean? EPS, by the way, EPS is earning per share. So how much my share will declare a net profit at the end of the year and how it is growing. So let's say last year, my yearly net earning is approximately $1 million. And today, this year, if I declare an income statement at the end of the year, and if my net income is $102 million this year, from 100 to 102, my EPS growth is just 2%. Okay, how much growing my earning per share is important for me by taking a decision to put how much money in each sector. So this year-over-year growth of the earning per share, please look at the title. And here, please look at what does this light blue, green, and the black line and the orange point. This is 2024 data. And this is average for 2001, and 2023. So 23 years average. So EPS margin average is just 2.7%. But today, EPS margin is really good, approximately 10%. But the revenue, on the other hand, 4.2% growth in the 23 years, but now revenue is growing just 101%. I'm asking this question to all attendances, and Dr. Lambert can answer this question as well. If I buy a company, and if I know that during last 20 years, it is revenue is increasing every year 4%, but this year it is just increasing 1%. Will I invest this company or not? No, I will not invest, because I am knowing that it is revenue margin is decreasing. Revenue is everything for me. Profit is everything for me by investing in a company. If that company is not creating a growth, is not creating a net earning, this meaning that this company will each year write a losses in their income statement, and approximately 5-10 years, it will go to a bankruptcy, right? I will not buy this company. My company should be every year a net earning, a profit, positive profit, not lose the money. And the share count, as you see here, even too small, but the share count is 0.3% increasing, but today is just 0. So the total EPS, as you see here, during those years, average is 7.5%, but the total EPS is 10.8%. This is a good indicator. But what it is creating, what is the source of this 10%, is just coming from the margins. Not because of the revenue, but the margins is triggering those type of things. And please look at this long dash line. Please look at here, for instance. The margin after the 2008 global financial crisis is 40%, or the margin is after the COVID-19 crisis approximately 48%. But this is not a good indicator. Why? After the crisis, because the previous year is really contracting, there is a base effect here, right? From 100, I'm dropping approximately 84, and from 84, I'm increasing again 100. So the increase in percentage seems to higher, but it is a base effect. It is not a real number, because in the two previous year, I contracted too sharply, and my 2 years ago value is really higher than today. So if I look at the 2020, 2024 or 2025 forecast at the end of the year, what does these numbers showing me? These are showing me that if these are the numbers, at the end of the 2024, my margin, my revenue, or my forecast will be around these numbers. Okay, this will be the real value of the EPS growth. So EPS growth, if I take those average, will not be higher than those average as well for the next couple of years, not just today, for the next couple of years. And please look at one of the best other indicator as well. This is profit margin. Profit margin is almost everything in the financial sector. And this is quarterly earning per sale. Okay, I'm dividing earning to sales, and I'm trying to understand what is the percentage of the profit. And as you see here, in the global financial crisis, profit margin is contracting too sharply. Again, in the COVID-19 crisis, it is contracting too sharply. But if I look at, and if I take a line from here to here, in the 2001, the profit margin is around just 6%. Yes, it is volatile. In the crisis period, it is even less than the 5%, or even in the COVID crisis, it is around 9%. But the overall trend is increasing from here to here, right? In the crisis period, I have a volatile output. But if I look at the long-term growth from 6%, now I'm around 12%. So profit margin is really good in the United States. So what is making the expensive those profits? What is making those indexes too higher prices? Because everybody bought the S&P 500 last 2 years. Why? Because United States economy creating too much good profit margins in their domestic economic outlook. And lots of investors expect that with these profit outlook, I can earn higher money, and they bought the stock exchange. And please look at this slide, earning, buyback programs, and dividend by sectors. S&P EPS growth by sector. Here you will see the sectors in the Nasdaq or S&P 500. Technology, financials, healthcare, consumer discretionary, communication, industrial, consumer staples, energy, utilities, materials, and real estate. So what does the screen say me? In the 2022, the best sectors is almost, by the way, look at this one. Best sector is industrials and energy, right? During the 2022, these energy and the industrials in each quarter approximately create higher than the 40% growth. This is perfect. Why? Because during the COVID crisis, industrials and energy going down. The oil prices is almost $1 in the future market, right? So energy is strictly going down. Then after the COVID crisis, it will have a compensation effect, right? It has a recovery in their prices. So their earning is really high. But now, if I look at the energy sector in 2024, it is nothing. Even in the first quarter, it is minus 25%. So if you put $100 million, you lost $25 million in just first quarter. Then you compensate approximately 11% of it. Then again, in the third quarter, it is forecast you will lose 4%. And the last quarter, it will be nothing. And in overall, you will lose approximately what? Minus 28 plus 1 11, it is approximately minus 17% loss you will get at the end of the year if you buy the energy sector in the S&P 500. But if you buy, let's say, the financial markets, like the banking sector, or if you buy the technology, your earning will be 25% in the first quarter, 16% in the second, 14% in the third quarter, and last quarter will be again 16%. So what is the overall in the S&P 500? This point is really, really, really important. The indicator is saying that if you put your money in the S&P 500 index, you will get 6%. What I said a few minutes ago, Dr. Lambert have $1 million. He want to buy a stock exchange, a company, and he will decide in which country he puts their money. Let's say Dr. Lambert decides to put their money in the United States, and he will buy an S&P 500 stock exchange. By the way, he can buy directly the index S&P 500 as well. So this indicator is saying that if you buy S&P 500 index, your return in the first quarter will be just 6%. But if Dr. Lambert is a good investor, he read lots of financial reports, he follow every news, and he understands that which sector he should put their money. Then Dr. Lambert decides that the communication services will be better in the first quarter. And if the Dr. Lambert put their money in the communication services rather than the S&P 500, he will earn approximately 42% in just one quarter if he puts his money in the communication services rather than the S&P 500. So first, I will decide which country I will buy, which indexes I will buy. Then I will also make a good allocation and categorization of the different sectors, because not every sector performs equally in each quarter. Some of them is positively differentiating, and some of them is negatively differentiating from the benchmark level of the S&P 500. So if I buy in the first quarter utilities, I will have a 28% return. If I buy technology, 25%. If I buy the consumer discretionary services, it is 21%. But if I made a mistake, and if I suppose that health sector also will be good, and if I buy a health sector, I will lose 25% of my money in just 3 months. Okay, we should be really, really careful which index I should put my money, and in that index, which sector I should choose and put my money as my investment. And total shareholder yield by sector here, as you see, in energy, consumer staples, financial, communication services, industrial, S&P 500, overall, materials, utilities, healthcare, consumer discretionary, information technology, and real estate. And the buyback, some company making a buyback program in their companies because they see that their company is really cheap in the stock exchange, and they are buying their stocks and shareholding in their stock exchange as well. This green line showing the buyback programs. And the dividend yield, you know that if Dr. Lambert buy an Apple stock in the stock exchange, and let's say Apple declare $200 billion net earning at the end of the year, and if Dr. Lambert is a shareholder in this company, from those 200 billion net profit, Dr. Lambert get a profit as well as shareholder according to their investment. Okay, this is your dividend yield at the end of the year. And now, value versus growth, valuation and interest rate. What we mean by value versus growth. This is a detailed topic, but these attendances should keep this word in mind. Value means a company who has a deep financial history, but the growth is like a startup. The company who is founded just 3 years ago, 5 years ago, it is growing too much. But the value is, let's say my company is approximately founded 30, 40 years ago. It made every investment, every capital expenditure, and now it is in the smooth period. It is a value company. But the growth company is, I found this company 3 years ago. It is like a startup and it is growing too higher last 3 years. So please look at this one. Growth, cheap, value, expensive ratio, and the recession period. This green dash line are the recession. And the value versus growth relative valuation. Here you will see relative forward price earning ratio of value versus growth from 1997 to present. And as you see here, this is time, and this is showing how much value versus growth is cheaper or higher. And as you see, the current PE ratio for the growth is 28, but value is just 15. What we say, value is a long history company. He made every investment, capital expenditure. He has a brand value. Okay, this company has a brand value, like Mercedes, like Apple, like the Amazon. But let's say growth is 3 years ago, a California company or San Francisco company just started with $60 million investment in the stock exchange. And it is growing too high. And his price earning ratio is 28. Okay. And the value versus growth in different rate environment, as you see, annualized total return. This is important. Annualized total return by 10-year trade, 10-year treasury rate range from 1980s till now, approximately 45 years. And if you see that US 10-year treasury rate range, and if I see this growth and value company, growth companies have almost higher return than the value company. But what is the problem here? So let's say, why Dr. Lambert will not directly buy a value or growth company? Let's say if growth company has always higher return, why Dr. Lambert should hesitate to put his money? Because this return is higher, but its volatility is higher as well. This year it can earn 15% money, but next year it can lose 30% because it is just startup. It doesn't have a brand value. It does not have a smoothing process. It is really volatile in the stock exchange. But the value company, not. Value company is just 30 years. He, how can I say this word? He proved his brand name. Okay, he proved everything in the market and he get the confidence and trust of the investor. So he doesn't need to increase their capital expenditure every year because he has a brand name. He has a label in the market. So put the money, especially in the risky environment, into the value company will save your money rather than to put your money in the growth sector and volatility and lose huge risky assets during those volatile times. And here, as you see again, value versus growth. And the cash, research and development, meaning how much they have cash in their bank account, how much money they are investing in research and development, and how much money they are putting in capital expenditure, like creating a new factory, like buying a new machine, and those type of things. Here, as you see, I have lots of different sectors as well. This is last quarter of 2024. The green one is the growth again, and the gray one is the value. And here, sectors, utilities, industrial, consumer staples, materials, energy, financial. And as you see, the communication services in the growth, approximately cash as 60%, huge money in their assets. So technology as well. But if you look at the, let's say, how can I say this? Utilities don't have any cash. For any type of risk, they cannot cover and compensate those type of losses because they don't have. They should borrow from the market. You should also take a look at how much the cash is ready in the different sectors for any type of losses and the crisis or the risk in the market as well. And the research and development and the capex by sectors, please look at this. R&D investment or capital expenditure investment in these companies, again, is huge and huge in communication and technology services, but it is really, really low in the materials and the real estate market. So even in cash, even in capital expenditure and research and development, communication services is the best sector to put your money, right? For instance, here, real estate have huge cash in their asset, but they don't have any investment, right? But the communication services have huge asset and cash, and they are making every year investment. This is the best case for us. So you can buy communication services without any hesitation in the stock exchange. And now S&P 500 index concentration and valuation and earnings. And here, as you see on the left-hand side, we have price-earning ratio of top 10 and remaining stock in the S&P 500. This is showing a forward price-earning ratio next 12 months, 1997, 1996, and present. And as you see here, this is showing current, average, and number of percentage of average, how much it is. As you see, top 10 is really higher price-earning ratio than the average. I understand that this is really expensive, but the remaining stock is not. They are really close and converging to their average, but the gap in the top 10 is really high. What does this mean? Lots of investors buy the top 10 companies in the S&P 500, and they pick up the price-earning ratio during the last year. And here, as you see, overall S&P 500 is around 16.6, but the current ratio is 21. I understand that S&P 500 is absolutely expensive to put my money as investment today. And weight of 10 stocks in the S&P 500. As you see, normally in the average, weight of 10 stocks is approximately 20-25%. But as their market value is really, really high today, the 7 giants like Amazon, Apple, Microsoft, Nvidia, those companies' market valuation is really high today. And as you see, their weight is approximately 40% today, rather than the average of 20% last year, because they are positively differentiating and their market valuation is really increasing in the stock exchange as well. Earning contribution to top 10 in the S&P 500, it is again around the average, and it is around 25%. This is earning contribution. It is smooth, but the market valuation, market capitalization is really high for the top 10. They are positively differentiating to average of the S&P 500. And the Magnificent Seven. What I mean by Magnificent Seven? These companies are like Amazon, Apple, Nvidia. These are the technology companies, and they are called as the Magnificent Seven. Huge performance. Please look at this green line. You will understand why we call they are magnificent. If you put your money in the S&P 500, but if you exclude those 7 magnificent from the index, your return will be 107.20%. Okay, but if you put your money those magnificent 7, it will be around 200%, 80% higher than the average. Hugely and absolutely positively differentiating company from the S&P 500 index average. So the investor who put their money in the Magnificent Seven during the last 2 years now are the millionaires. But the S&P 500 not. They are earning smoothly, but these are now the millionaires. Earning growth, as I say, EPS growth. And here, EPS growth, if you look at this one, in the first quarter, Magnificent Seven earning growth is approximately 50%. So Magnificent Seven is not a price bubble. It is not an asset price bubble. They are creating an earning. It is not just bubble. There's a story behind that. Their profit, their net income is increasing in the first quarter 50%. So there's a reason why they are positively differentiating from the index average. because they are really creating an earning profit. But for the next 2 quarters, those magnificent 7 earning will converge to the S&P 500. So if the attendances in this presentation holding their magnificent 7 in their portfolio in the stock exchange, I think it is time to sell. And our basic methodology in the financial sector is this: sell the expensive and buy the cheap. Now the magnificent 7 is expensive. Sell it and buy the cheaper one in S&P 500. Small capitalization, medium capitalization, and large capitalization. This means that how those capitalization in the stock market is differentiating. For instance, a small company is small capitalization, or the Amazon is large capitalization. And please look at here, information technology companies is hugely capitalized, and they are really large capitalized markets, as you see here. And large capitalization in the growth company is 63%, but in the value it is just lower. Why? Because the value, as I said, does not need to prove its label. It has a brand name during 30 years, but the large capitalization should be higher in the growth sector. And I want to say this interest rate coverage ratio. What does this interest rate coverage ratio for us? This means that I have an earning, net profit, but every year I'm paying a borrowing from the bank. And how can I pay with my profit? How many times I can pay my interest rate expenses? And if the coverage, interest rate coverage ratio is higher, my company is good company, because I can pay higher and higher times of interest expense with my net profit. But if it is dropping, this means that rather than the main money, I even cannot pay the interest rate expenses of those borrowers. This is not a good story for me. And now, the return versus valuation by style, as you see here. And this is 10-year annualized return here. Okay, this is peak of the 2020. This is start of the COVID-19 crisis, right? In the March, we declared there's a crisis. There's a COVID problem in the world. So before the COVID problem, the market peak is here. Then the market lowest is March 2020. In 1 month, everybody lost and sell everything. And now, please look at this story. Current PE ratio versus 20 years average in the price earning ratio. And in the value company, my price earning ratio is really low, but in the growth company, it is really high. So in these volatile and turbulent times, if I have money, rather than to put the money in the growth sector, I will buy the value sector, because their metrics in the valuation showing that they are cheap, but the growth companies are expensive today. And the last slide on my side is this: return versus valuation by sector. As you see here, I have energy materials, financial industrials, consumer discretionary, technology, communication services, real estate, healthcare, and the overall S&P 500. And I have their weight. As you see, the highest weight is almost in the consumer discretion and technology sector, or financial sector, as you see, higher than the 10%, but technology is approximately 1/3 of the S&P 500, right? Technology is everything for the S&P 500. And as you see, their weight in the other sectors like Russell is approximately 46%. And how they are performing? Please look at the technology sector. They are performing in every sector and in every quarter, positively differentiating. So if you are a longer term investor, if you are putting your money and don't want to look at the screen for the longer term period, you will decide first which index and which country you will buy. Today, China is cheaper, United Kingdom is cheaper, but the United States and Euro market is expensive. Emerging markets, China and the United Kingdom is cheaper, but the developed market, the rest of the developed market is expensive. So you decide that cheaper market is good. So I will buy United Kingdom and the Chinese market. Then I will decide which sector I will buy, which sector is negatively differentiating and more cheaper than this index average. Then I will put my investment, don't look at screen, and just take the opportunity of the long-term investment and the power of the compounding.